The Australian dollar started the week very strongly, pushing above 77.50, but it fell 1.5 cents after Australia's shocking CPI data. The overall price level fell 0.2% in the first quarter, though it is still up 1.3% over the year. There were steep falls in fruit and petrol prices in the quarter, and these may well rebound in the second quarter so that we don't see another negative then. However, excluding the impact of the most volatile items in the inflation basket, underlying inflation is running at about 1.5% over the year. The Reserve Bank targets inflation over the medium term in a 2 to 3% band. It does have tolerance for movement outside the band on either side, but the question is for how long? Before the CPI release, markets had been very comfortable about the RBA decision in May, pricing only a 10% chance of a rate cut. Following the CPI shock, this surged to above 50%, settling down around 53% chance. Westpac Chief Economist Bill Evans is maintaining his long-held view that the cash rate remains at 2%. Indeed, the RBA for some time has already indicated that the inflation rate is likely to be low enough to not pose a barrier to another rate cut. Instead, it has been saying that it is focused on the growth outlook. And the news since the last meeting of the RBA on the growth side has been pretty encouraging. We've had the unemployment rate falling to 5.7%, a low since September 2013, and we've had an improvement in business surveys. All of this argues for the RBA to keep rates on hold. But the inflation surprise can't be ignored, so markets are likely to be deeply divided about the RBA's decision right up to the announcement on Tuesday afternoon. And this is likely to be pivotal for the Australian dollar. If they hold steady as Westpac expects, then the Aussie could bounce to about 77.5 cents. But if they do cut rates, markets are likely to anticipate further interest rate cuts, and that's likely to knock the Aussie down to at least 75 cents, perhaps somewhat lower. If we do see a steady hand from the RBA in the week ahead and it produces a bounce in the Aussie dollar as we expect, then it's probably going to be a similar sort of response to what we saw from the Reserve Bank of New Zealand and of the Bank of Japan this week. Both of them were expected by a number of people in the market to ease policy further, but they did not. So we've got a sharp rise in the Kiwi and the yen in particular in response. So it may be that there is a little bit of a theme emerging that central bankers are thinking that they have done enough in terms of providing very loose monetary policy. As for the Federal Reserve, the FOMC statement this week was reasonably cautious, particularly on the domestic economy, though they did sound less worried about the global economy. Overall, that didn't do too much damage to the US dollar, and neither did a weak reading for first quarter GDP, with the second quarter of the US economy looking better. As a result, the US dollar is holding up reasonably well, and given what we saw from Australia's CPI reading, it now looks unlikely that the Australian dollar will be able to push through 80 cents as seemed likely previously. However, we wouldn't be too bearish about the Aussie over the weeks ahead. If we do get that steady hand from the RBA, that will obviously lend support short term. And we've also got some support from commodity prices, with both iron ore and energy prices holding up quite well. That should limit the downside to the Aussie to around about the 74 cent area in coming weeks. We'll speak to you next week.